Mindvine Studios presents.
Welcome to the Deep Dive. We're here to break down complex stuff and give you the core insights. And today, we are jumping right into the deep end of 1980s Wall Street, specifically Salomon Brothers, seen through the eyes of an insider. We're drawing a lot from Michael Lewis's classic Liar's Poker.
Yeah, it's an amazing source. Imagine this scene, the trading floor, and there's this game, Liar's Poker.
Yeah.
It wasn't just some, idle game.
Yeah.
You had the chairman, John Gutfreund, they called him the King of Wall Street, challenging John Merriweather, one of his top traders, to $1 million hand.
$1 million on a single hand of Liar's Poker.
Exactly. And that really captures the essence of Salomon Brothers. It showed that, bold risk-taking, sheer nerve, that was valued maybe even more than your typical qualifications, kind of institutionalized recklessness in a calculated way.
Wow. And yeah, this story is just filled with these incredible characters, these moments that make your jaw drop. So our mission today is to guide you through this. This really chaotic time, we want to help you connect the dots, between the personal stories and what was happening in finance overall.
We'll unpack that unique, sometimes brutal culture in Salomon, look at how they sort of unexpectedly dominated the bond market.
Yeah.
And explore the huge shifts happening then that really shaped finance for years to come.
Yeah, get ready for some surprises, definitely some aha moments along the way. Okay, so let's start with the author himself. His path to Wall Street was, it wasn't exactly standard, was it?
Not even close. He was an art history major. He talks about flunking physics for poets.
Physics for poets, I love that.
Right. And his resume had things like bartending, skydiving, absolutely zero background in investment banking.
Which just blows my mind. And he was apparently really upfront about why he wanted in.
Oh, yeah, brutally honest. He told interviewers straight up.
Yeah.
It was about the money. And that was apparently a huge taboo at other firms like Lehman Brothers. You were supposed to talk about, the challenge, the deal-making excitement.
Never the cash.
Never the cash. So the fact that Salomon was okay with that, maybe even liked it, it tells you something.
It really does. It suggests they were looking for, raw ambition, not some polished shield.
Exactly. Raw hunger. And their whole recruitment process reflected that.
Yeah.
It's weird, like a test in itself. Picture this.
Mm-hmm.
The author's at some fancy charity event in London, right? Hoping to see Princess Di or someone.
Okay.
And the wife of a senior Salomon managing director basically corners him, turns the whole evening into this intense hour-long job interview.
At a charity gala? Seriously?
Seriously. And even after that, Salomon never actually made him a direct job offer.
What? So how did he get the job then?
They just gave hints. Apparently, another student told him Salomon was too smart to give people the chance to turn them down. So the author had to basically call up the head of recruiting, Leo Corbett, and just accept the job, a job he was never formally offered.
That's a power move, isn't it? Making you chase them like that.
Absolutely. It was all about proving your desire, your ambition.
Mm-hmm.
And it says a lot about the power dynamics there, especially when you look at the kind of money involved.
Right, the money. That part really stood out to me. He was, 24? No MBA?
Yep, 24. Starting salary was $42,000 plus a $6,000 bonus. So $48,000 total.
48 grand in the early 80s. And how did that compare?
Well, the book points out a tenured professor at the London School of Economics, maybe in his mid-40s, top of his field, earned half that.
Half. That disparity is just staggering. It really shows you where the money and the power was shifting, doesn't it?
It really does. It paints a stark picture of how that whole Wall Street environment was, vacuuming up wealth in a way that academia or other traditional professions just couldn't match. Even so, the author initially felt like an outsider, a geek or a dilettante next to all the Ivy League prep school types. He felt like choosing art history was like taking a vow of poverty.
Until he got that paycheck, I guess. But that culture, the audacious bets,
Mm-hmm.
It all comes back to that game Liar's Poker. You mentioned the $1 million challenge.
Yeah, Gutfreund, the king, challenging Merriweather. And Merriweather felt he had to play. It was this gunslinger code. Playing was expected, even if it was, frankly, stupid.
What a bind. Win, and you tick off the boss. Lose, and you're out $1 million.
Exactly. So Merriweather does something even bolder. He challenges Gutfreund for $10 million.
$10 million? What did Gutfreund do?
He just smiled and said, "You're crazy," and declined. But can you imagine the nerve?
Incredible. And Merriweather had this group around him, right? These young traders.
Yeah, his boys, mostly PhDs, math, economics, physics. They became obsessed with Liar's Poker, saw it as their game, took it incredibly seriously.
So this wasn't just about ego. It was baked into the culture, this constant testing of nerve.
Deeply baked in. Every trade, every decision was a test. Aggressive conviction, even with millions on the line, that's what earned respect. And it shaped how the place was structured, too. Or rather, how it wasn't structured in a traditional way.
How so?
Well, despite the MBAs drawing up these fancy organization charts like Christmas trees on the trading floor, rank didn't really matter that much. What mattered was making money. Period.
A pure meritocracy of profit. So what kind of personalities really thrived there? Can you give us some examples?
Oh, the book is full of them. There was this one trainee, Myron Samuels, rumored to have connections. He somehow got excused from the usual hazing, the tough initiation rites everyone else went through.
And he flaunted it.
Totally. He'd stroll around, get a shoe shine right there on the floor, light up a cigar, put his feet up on the desk, stuff nobody else would dare do. It showed you the real hierarchy.
Wow. Definite picture there. Who else?
Then you had the infamous human piranha. Real name was Sangfroid. Tall guy, bit chilly, mild British accent.
Intimidating.
Oh, he was. He'd grill the trainees with these obscure financial questions, like the TED spread.
The TED spread. Okay, what's that for us non-traders?
It's basically the difference between the interest rate banks charge each other, that's LIBOR, and the rate on short-term U.S. government debt, the T-bills, a measure of perceived credit risk in the economy.
Got it. So he'd just throw these curveballs at trainees.
Exactly. And his threats weren't idle. People said he was a man of his word. If he said he'd ruin your career, you believed him.
Yikes. Not exactly warm and fuzzy. Was there anyone...
Yeah. Decent. Well, there's a mention of a guy named O'Grady. He was a bond salesman described as a rare and much-needed example of goodness. Apparently, he once told off a recruiter in colorful terms, got fired. But Salomon later rehired him because, well, he could make money. The author saw him give change to a beggar once, which was apparently something you just didn't see on the floor.
A moment of humanity. So how did personal stuff fit in? Because the book says there was this rule, no crying, no weakness, ever.
Yeah, an absolute unwritten rule.
Well,
no one ever cried on the trading floor. No one ever showed weakness or vulnerability or need for human kindness.
Huh.
Alexander, another character, advised the author. Always maintain a strong exterior, even if you're exhausted, even if something terrible happened in your personal life.
So if you showed up after, say, a personal tragedy, you just faked it.
You had to. The example given is if you hadn't slept, maybe lost a friend, and some big swinging dick, that's what they call the top producers, asked how you were. You didn't say terrible. You said, I'm great. How the hell are you? Complete emotional lockdown.
That sounds exhausting and kind of toxic, honestly.
It does. Interestingly, the author ended up in the London office later, and it had a slightly different vibe. The New York traders apparently called them Monty Python's flying investment bankers.
Because?
Because they thought the London guys slept late, took long, boozy lunches, maybe a bit more relaxed.
A dust cloud for geeks, as the author put it, a place to hide a bit.
Yeah, maybe give them a bit more breathing room. But speaking of the main machine, that New York engine, its massive growth, really ties back to a huge shift in the financial world, triggered by Paul Volcker in October 1979.
Volcker, the Fed chairman. What exactly did he do that was such a game changer for Salomon?
He basically announced the Fed would stop tricks to control interest rates directly to manage the economy. Instead, they'd fix the money supply and let interest rates float wherever the market took them.
Okay, fix the money supply, let rates float. Why did that turn the bond market into a casino, as the book says?
Because before that, bonds were seen as, pretty boring. Stable, predictable returns. Suddenly, with rates floating freely, bond prices could swing wildly. They became objects of speculation, not just steady income. Volatility shot up, trading volume exploded, and Salomon, being big in bonds, just rode that wave. Cue a massive hiring spree.
And right in the middle of this bond explosion was Louis Ranieri, wasn't he? But he didn't start out thrilled about mortgages.
Not at all. When they put him in charge of the mortgage department back in '78, he felt like he'd been exiled to Siberia. He thought mortgages were the ugly stepchild of the bond market. Who would even buy these things?
But he became fiercely loyal to Salomon, didn't he? There's a story about that.
A really powerful one. Ranieri started in the mailroom. Early on, his wife had a serious medical issue, racked up a $10,000 hospital bill. Huge money back then. He was terrified, thought he'd be fired just for asking Salomon for a loan.
And what happened?
He went to a partner, explained the situation, and the partner just said, it will be taken care of. Salomon paid the entire bill for a mailroom clerk's wife. That act, for Ranieri, wasn't just generosity. It created what he called a covenant, a deep, almost family-like bond. The firm looked after its own, And in return, he felt this unwavering loyalty. He said he loved the firm, even though he knew deep down it was only a business.
That explains a lot about his drive. And then the market handed him this incredible opportunity with the thrifts, the savings, and loans.
Oh, yeah. The blessed ignorance of the thrifts. In 1981, Congress passed this tax break. It essentially forced thrifts to sell off their old low-interest mortgage loans to realize the losses for tax purposes.
So suddenly, there's this massive supply of mortgages for sale.
Massive. Like $1 trillion worth of this debt hitting the market. And who was there to buy it? Basically one entity, Louis Ranieri and his mortgage desk at Salomon.
And the thrifts didn't really know what they were doing.
Not really. They were often called the 363 Club. Borrow money at 3%, lend it out at 6%, hit the golf course by 3 p.m. They didn't know the value of what they were selling. They were so focused on the tax break, they'd sell stuff cheap. Salomon could even get them to swap nearly identical loans and pay Salomon a huge fee, like $10 million, just for facilitating it.
Unbelievable. Exploiting the information gap.
Totally. The mantra on the Salomon sales floor was, apparently, come on, people, we're not selling truth. Pretty blunt.
Yeah, no kidding. So this environment, it fueled a ton of financial innovation, right? Salomon's traders basically wrote the rules.
They did. The author calls them people with PhDs in man's ignorance. They figured out they could even overpay for bonds sometimes, just to control the flow, get a corner on the market. Then they'd release research justifying the higher price they just paid.
Wait, how does that work? You buy high, then tell everyone it's actually worth that much?
Pretty much. They understood the market dynamics better than anyone else. By buying up a big block, they controlled the supply. Then, their research department would issue a report saying, hey, based on our analysis, these things should be priced higher. They were essentially creating their own reality, validating their own trades. It was audacious, but it worked because they were the market for a while.
Incredible. And then came CMOs in 1983, collateralized mortgage obligations. How big a deal were those?
Huge. Absolutely revolutionary. Before CMOs, mortgages were messy. You didn't know exactly when you'd get your money back because people refinance or sell their homes. CMOs sliced and diced big pools of mortgages into different pieces, different tranches, each with different levels of risk, and crucially more predictable repayment timelines.
So that made them attractive to big investors.
Exactly. Suddenly, these mortgage products looked much more appealing to institutions like pension funds. They needed that predictability. The numbers tell the story. June 83, basically zero pension fund money in mortgages. Mid-86, they held something like $30 billion in CMOs.
And growing fast.
So all this complex new stuff, it meant the younger traders had an advantage.
Big time. Because the innovation was constant. New products, often these off-balance sheet things, were being invented all the time.
What does off-balance sheet mean, practically?
It means complex instruments, maybe derivatives or structured deals, that didn't show up neatly on the company's main financial statements. They were harder for older managers who weren't in the weeds to track and understand. So the tykes, the recent trainees, they understood this new stuff because maybe it was only invented last month. They became the experts overnight, which gave them incredible power, bypassing the usual hierarchy.
But this explosive growth, this hyper-growth, it eventually caused problems, didn't it? Like dumping too much fertilizer on a plant, the author says.
Yeah, the very thing that made them successful started to, well, undermine them. Training classes were doubling every year. The firm got huge, incredibly fast, and the internal systems didn't keep up. What worked when they were a smaller partnership focused on profit splits just didn't scale well as a big public company.
What was the core issue?
A major one was the shift from focusing on profits to focusing on revenues. Managers were incentivized to just grow their desks bigger and bigger, generate more top-line sales, without necessarily considering the costs or the actual bottom-line contribution. Plus, they apparently had no real system for allocating costs. Departments weren't really held accountable for their expenses. It created inefficiencies and internal friction.
And amidst all this, they kind of missed the boat on junk bonds, right? Even though that market was exploding too.
They did, which is ironic given their appetite for risk elsewhere.
Yeah.
But apparently senior management just didn't understand junk bonds, didn't feel comfortable with them.
And didn't Louis Ranieri, Mr. Mortgage himself, actually work against Salomon's own junk bond efforts?
Yeah, that's one of the most stunning parts. Ranieri, who these thrift managers saw as their guru, their savior, he apparently went to a seminar for them and basically said, junk bonds are dangerous. Steer clear. Undercutting his own firm's department. Why? Maybe ego. Maybe he saw it as competition for capital. The book suggests it was possible only because there was a real lack of leadership on the 41st floor, the executive suite. A vacuum at the top allowed these internal conflicts to fester.
And this internal strife, the compensation issues, it led to people leaving. The brain drain.
Absolutely. Top mortgage traders started getting poached by competitors. Merrill Lynch, First Boston, places like that offering way more money. People like Howie Rubin, Andy Stone. Rubin even said leaving felt like leaving a family, which really speaks to that broken covenant Ranieri felt so strongly about.
So the loyalty cracked under the financial pressure.
It seemed so. The feeling was, why stay if the firm wasn't valuing your contribution properly? As the book says, Salomon Brothers became a great place to be from. Its ex-traders went on to build up the mortgage departments everywhere else, spreading the knowledge, eroding Salomon's monopoly. Guys like Mortora felt severely penalized by the pay system.
There's a story about Andy Stone getting a huge offer.
Yeah, Merrill Lynch offered him 4 times his 1984 pay. Salomon management apparently panicked then, tried to keep him, but it was too little, too late. The talent was walking out the door.
Now, the author had his own high-stakes drama, didn't he? Selling those Olympia and York bonds.
Oh, yeah, that was a huge deal for him personally.
Yeah.
$86 million worth of these bonds for a big Arab client. They were toxic. Nobody wanted them. A real headache for the firm.
And who finally got the deal done?
It was the human piranha, believe it or not, using his usual persuasive tactics, I guess.
Ah, okay. And after the deal closed?
The author got calls from everyone. All the top brass, Strauss, Massey, Ranieri, Merriweather congratulating him. Big moment. But then some other guy, an opportunist, tried to swoop in and take credit.
Classic. How did the author handle that?
Pretty cleverly. He used what he called phone bombs, basically making calls to ensure the real story got out, exposing the opportunist. It led to this tense late-night showdown where the opportunist actually threatened to fire him. No, the author realized the guy was bluffing. And that realization itself, knowing the bluff, was power. A key Wall Street lesson learned.
Fascinating. Okay, let's jump to the end of that era, or near it. October 1987, Black Monday, the stock market crash. What was the scene like at Salomon?
Eerily quiet, apparently. The trading floor, usually chaotic, was described as gelded, silent. Empty desks had these leftover inspirational signs. Very strange atmosphere.
And layoffs followed.
Brutal ones. And the book notes they disproportionately hit women, partly because many were concentrated in departments considered loss leaders, like money markets, which got cut heavily.
That's rough. But interestingly, while the stock market tanked, the bond market did okay.
Better than okay, it soared.
Right.
Which seems counterintuitive, right? But the logic was, stock market crash means likely economic slowdown, which means the Fed will probably lower interest rates. And lower interest rates mean existing bonds, with their higher fixed rates, become more valuable. So bond prices went up.
A contrarian move.
Yeah.
And what about those junk bonds they mostly avoided?
They collapsed immediately after the crash. So in hindsight, Salomon's reluctance looked like genius, or at least good luck. The author mentions a French client actually thanking him for never selling him any junk bonds. It just underscored how chaotic and unpredictable it all was. Even a powerhouse like Salomon had strikingly little control of events sometimes.
So what a ride through Salomon Brothers in the 80s. We've seen these really unlikely paths to huge wealth.
Yeah, the art history major making a fortune.
This bizarre, intense gunslinger culture shaping everything.
Liar's poker as a way of life.
And this incredible wave of financial innovation, especially in mortgages, driven by, smart people exploiting a situation, Ranieri's drive, and that blessed ignorance of the thrifts.
Definitely. Yeah. But we also saw the dark side, didn't we? The human cost of that crazy growth, the internal backstabbing, how that covenant of loyalty ultimately couldn't withstand the lure of bigger money elsewhere.
Yeah. And that line from the book really sticks with me. Goodness was not taken into account on the trading floor. It was neither rewarded nor punished. It just was, or it wasn't.
It's a stark thought, isn't it? That in that environment, personal character, morality, it was just irrelevant to success. Profit was the only metric that mattered.
Which makes you wonder, in these high-stakes games where the rules seem to be constantly changing, and maybe, as one trader said, those who know don't say, what does it actually take to win? And what does that kind of environment do to people? Something to think about until our next deep dive.
Thank you for watching. Please like and follow for more.